Welcome to Objective 1 in Unit 6 on Principles of Revenue Recognition for Accounting 3310. In this first objective, we're going to look at the general principles of revenue recognition that are used to determine whether in a particular transaction the company has actually accomplished a sale or not. The crucial question in the area of sales is determining when goods are completely transferred to customers and when service agreements are completely fulfilled. This is a surprisingly difficult question when there are ongoing interactions with customers because of shipping or rights of return and many more features presented here. How can revenue be recognized consistently across many selling situations? In this objective, students will learn to apply the principles of revenue recognition to a variety of sales situations. The basic principles for revenue recognition are simple, but hard to apply. The earnings process is virtually complete and collectibility is assured are the statements from generally accepted accounting principles. Notice that the earnings process can be virtually complete and not absolutely complete, and that allows some judgment then for the variety of things that can happen in a sales transaction. The next item requires judgment also. That is, one doesn't need to have collectibility already taking place. Instead, one needs to have the confidence that collectibility will happen, and that's sufficient to be able to recognize revenue. There are more specific criteria when we read the Security and Exchange Commission's interpretation of the revenue recognition rules of the Financial Accounting Standards Board. These are the 4 rules that were written in a staff accounting bulletin from the Securities and Exchange Commission. There needs to be persuasive evidence that an arrangement exists. That is, you need to have some understanding with the customer. Delivery has occurred or services have been rendered. This is a clearer statement of what it means for the earnings process to be virtually complete. The seller's price to the buyer is fixed or determinable. That is, we can't have an arrangement if we don't know what the amount of that arrangement is going to be. And finally, they left intact that collectibility is reasonably assured. The first issue we have is that there are a variety of different timings between the event of the sale and the payment. Revenue recognition uses these general principles to recognize revenue when goods and services are provided to customers, no matter when the payment is made. This is the direct application of accrual accounting. These are the 3 general patterns. First, there could be a prepayment. There could be concurrent payment, or there could be subsequent payment. Let's take a look at these transactions. Here are the journal entries that are written to recognize revenue when there's a prepayment. The important point is, when one receives the customer's money ahead of time, revenue is not recognized. Instead, it's a liability called unearned revenue. Think about this as air traffic liability when you buy an airline ticket. Then, at delivery, unearned revenue decreases and revenue is recognized. When there's concurrent payment, we have the simplest of all sales transactions, in which cash is increased and owner's equity is increased. When there's subsequent payment, we use the accounts receivable to hold the asset of the promise of the customer to pay. So at the time the sale takes place on account, we increase accounts receivable and increase revenue. Then when there's payment, there's no additional revenue recognized at that time. It's just a trading of assets, increase in cash, decrease in accounts receivable. The following are examples of items that can prevent a sale from resulting in revenue being recognized in a company. When revenue cannot be recognized, the profit in the transaction is deferred as a liability until the revenue recognition criteria can be met. First of all, there may be shipping issues. FOB destination means that delivery and revenue recognition occurs when the customer receives goods. FOB destination means that the seller still owns the goods during the shipping process, so delivery has not happened until the goods actually get to the customer. FOB shipping point is the opposite. Delivery and revenue recognition occurs immediately when the seller ships it because the goods belong to the customer during transit. Another shipping issue happens when we have the peculiar case where a customer requests delay in shipping. A bill and hold transaction occurs when a customer's order is absolutely complete and ready to go, but the customer requests for its own convenience that the shipping not take place yet. This would be very annoying to that seller who had intended to recognize revenue, and in fact that seller has fulfilled all of the seller's obligations and stands ready to do the delivery. So in generally accepted accounting principles, we have this very narrow exception called bill and hold, when a sale can result in revenue recognition even though actual delivery hasn't taken place. These are the criteria that must be met. The buyer has all of the risk of ownership, that is, title to the goods has already transferred to the buyer. There's a fixed and reasonable delivery schedule so that we know that it will be delivered to the buyer. The goods are segregated and ready for shipment, so this has to be in the case where, but for delivery, the goods were ready for sale. And finally, the seller has completed all performance obligations and has no additional obligations to the customer besides the delivery. When these criteria are met, then a company is able to recognize revenue prior to actually shipping the goods out to the customer. Another set of issues occur when we consider likelihood of payment. When there's prepayment or when there's a cash sale, then we already know at the time of delivery of the goods that collectability is assured. It's already happened. But when there's a credit sale, then there may or may not be assurance of payment. The kind of things that companies do in order to be assured of payment is to do credit checks on their customers or to set up application processes for their store credit cards. A credit sale with no assurance of payment occurs when the company does no credit check, is completely willing to sell on credit terms to anybody who walks in the door. We'll talk about these sorts of sales later on in this unit, but be assured that it can be a very profitable business. It happens mostly when what one is selling is something that can be repossessed. So if payment doesn't take place, the used car dealership goes and gets the car, or the furniture dealer repossesses the furniture. There are some terms of sale that indicate that the sale is not absolutely complete and revenue can't be recognized. If there's a contract with customer acceptance rights, then delivery alone is not enough to recognize revenue. Instead, the customer must actually have tested and approved the shipment before revenue is recognized. This happens most often with technology goods or perhaps with parts and components that are going to be used in manufacturing, where the goods are accepted if they meet particular quality standards. And so revenue recognition must wait until the customer indicates that those quality standards have been met. Another feature is that sales sometimes take place with additional future obligations of the seller. No revenue recognition takes place if the supplier is unable to value those future costs. Revenue recognition occurs only if the future costs are measurable and accrued. So we may have a situation where in buying your used car, there's a commitment to the next year's worth of oil changes. Well, that is a very measurable item. We know what that costs, and so that would not prevent a sale. But what if we sell a used car and say that we will maintain that car for the next year? that may not be measurable because of the vast uncertainties in the quality of a used car. And so in that case, we may have to wait until the maintenance period is over in order to recognize revenue. An alternative revenue recognition scheme exists for long-term construction contracts. This is an issue in revenue recognition because there are some goods that take more than a year to manufacture, or maybe even several years. Think about companies that make cruise ships or satellites or construction of large buildings. Those items are going to have work taking place over an extremely long period of time for a particular customer, and the customer probably is making periodic payments along the way. But delivery is delayed just because the size of the product is so massive. Generally accepted accounting principles has felt that it's not right to say that there is no revenue taking place during construction for these items, because there's a lot of assurance here of acceptance of these goods, and it would be misleading to show only expenses and no revenues while the construction is going on. Here are the conditions that need to be met in order to recognize revenue during production. First, there needs to be a reasonably dependable estimates can be made of the extent of progress toward completion, contract revenues, and contract costs. We certainly can't recognize revenue if we don't know how much. The contract clearly specifies the enforceable rights regarding goods or services to be provided and received by the parties, the consideration to be exchanged, and the manner and terms of settlement. That is, we've got to make sure that we've got an agreement by both sides and we know exactly what's going to be paid. Third, the buyer can be expected to satisfy its obligations under the contract. This is an application of that collectibility is assured. And finally, the contractor can be expected to perform its contractual obligations. So the seller needs to have assurance that they're going to be able to complete the job that they've started. In this narrow set of circumstances, revenue can be recognized while the product is being constructed. Otherwise, revenue is recognized at delivery with no interim revenue recognition. There's an alternate revenue recognition policy for crops and commodities. At the time of harvest or at the time of production of the commodities and before delivery, revenue recognition can sometimes take place. It's based on the following criteria. A fair market price for homogeneous good is available, and the earnings process is deemed virtually complete because the product is in storage awaiting sale. So, think about corn. At the time that corn is harvested, it's available for sale, it's in storage, it can be sold at any time. But the farmer is typically going to be watching for the appropriate selling price in order to sell that crop. So the sale itself may take place many, many months in the future. But this is a commodity. Every bushel of corn is like every other bushel of corn, and there are market prices for corn that are reliable. So a farmer can go ahead and recognize revenue at the time of harvest up to the market selling price for corn, and he will hold then that inventory at that market price. So when revenue here is recognized prior to the actual sale and delivery to the customer, it increases the value of the inventory on the books of the seller. There are also some measurement issues that need to be considered when thinking about revenue recognition. When we have revenue recognition take place, so far we've really been talking about the customer paying cash. But if the customer pays using some other assets, then we're going to measure revenue at the cash equivalent value of whatever consideration is received. If it's a pure barter situation where there's no cash involved at all, then the item that's received in trade, if it has a regular market value, that will be used. But if there's no regular market value, then the revenue is going to be recorded at minimum value if no cash valuation is possible. So this is the case if we have a sales transaction in which the other party is going to provide us with services that it doesn't provide to anyone else, so it has no market value. We will not be able to simply pretend that this must be $1 million sale without any evidence to back it up. The best example of this happens among online internet companies that agree to mutually advertise on each other's site. This generates advertising revenue for each party, but there's no objective way to measure what the value of that advertising revenue is. And so our standard here is that it's put on the books at minimal value. We have covered all of the revenue recognition general issues, and now it's your time to practice. Take a look at each one of these practice items, pause the video, identify what your journal entry would be, and then pick the video back up again and see what the solution is. Here's a cash sale for merchandise with a selling price of $100 that's purchased for cash on October 30th. This is our basic cash sale. Here's the solution. Now let's look at sales in fulfillment of a prepayment. Merchandise with a selling price of $100 is purchased on October 30th by using a gift card that was obtained on October 15th. Here's the solution. On October 30th, we've fulfilled the sale and we are decreasing the liability of unearned revenue and recognizing the revenue. Now let's think about a credit sale. Purchase on October 30th of $100 of merchandise in a periodic inventory system with payment on November 5th. Think about how you would record this. Our solution is to record the sale and recognize accounts receivable, and then at the time the payment is received, to decrease the accounts receivable. This is the end of our basic introduction to revenue recognition.